Every dollar you contribute to a retirement plan eventually reaches a point of divergence, the choice between an immediate tax break or tax-free growth. For years, the move to a Roth account was a hedge against the future. Savers assumed that temporary tax cuts would expire, and income taxes would eventually have to rise. That calculation shifted on July 4, 2025. With the One Big Beautiful Bill Act, the government converted those temporary tax brackets into a permanent structure. Because these rates are now stabilized, the IRS evaluates your optimal retirement vehicle based on the 2026 income phaseouts and specific compliance triggers. Success in the 2026 tax year relies on aligning your current MAGI with the long-term liquidity and estate goals of your specific life stage. A traditional 401k provides an upfront return by lowering your current year adjusted gross income. The Roth IRA works from the opposite end. You contribute after-tax dollars today to secure permanent tax immunity and eliminate future withdrawal requirements. But the Secure 2.0 Act has introduced a series of mandatory changes for 2026. For high earners, accessing that tax-free growth now involves navigating a new set of administrative hurdles. The decision is a trade between the guaranteed ROI of a current deduction and the flexibility of future tax-free access. But capturing that flexibility requires a clear understanding of the new regulations. Your eligibility for these accounts is governed by your Modified Adjusted Gross Income, or MAGI. For households with access to a workplace 401k, the IRS applies a sliding scale to the traditional IRA deduction, phasing it out entirely as your income climbs. This creates a specific planning gap. For married couples filing jointly, earning between $149,000 and $242,000 results in no tax deduction for traditional IRA contributions. Yet inside that same income range, you remain fully eligible to put money directly into a tax-free Roth IRA. Earning above $252,000 removes the option for direct contributions to either IRA. These rules effectively force mid to high earners to utilize their workplace 401k for pre-tax savings, making the Roth IRA the primary vehicle for any supplemental retirement funds. The Secure 2.0 Act also introduces a Rothification mandate for 2026, specifically targeting workers age 50 and older. If your FICA taxable wages from your employer exceeded $150,000 in 2025, you are subject to this rule. In this bracket, all age 50 plus catch-up contributions must go into a Roth account, which can remove up to $11,250 from your potential pre-tax deductions. High earners above the $252,000 limit often look to the backdoor Roth strategy, where you make a non-deductible contribution to a traditional IRA and then convert it. However, the IRS pro rata rule creates an immediate tax liability if you have existing pre-tax accounts. Under IRC Section 408(d)(2), the IRS views all your non-Roth IRAs as a single pool to determine the taxable portion of your conversion. You can isolate those funds by performing a reverse rollover, moving your pre-tax IRA assets into your current workplace 401k before you attempt the conversion. For those at peak earnings, tax-free growth requires active coordination of your various account types to avoid double taxation. Locking up capital until age 59.5 can be a significant constraint for those pursuing early retirement or managing emergency funds. The Roth IRA has a distinct liquidity profile. Since your contributions were made with after-tax dollars, you can withdraw the original principal at any time, for any reason, without taxes or penalties. Accessing a traditional 401k is far more restrictive. Early withdrawals generally trigger a 10% penalty on top of ordinary income taxes. The 401k does have one unique advantage: the Rule of 55. If you leave your job at age 55 or later, you can take penalty-free distributions from that specific employer's plan. While the Roth IRA provides the most flexibility for those who might need their capital early, the traditional 401k offers a very specific off-ramp for late career job changes. Managing these accounts effectively means building a strategy of tax diversification based on your current tax bracket and future goals. Consider the high bracket optimizer in their peak earning years. This profile should prioritize the traditional 401k to lower their current AGI and stay out of the top 32% tax brackets established by the OBBA. Then there is the early retiree, who prioritizes intermediate liquid. You should build a blend of both account types. Having a source of tax-free Roth income allows you to manage your taxable distributions in retirement, which helps preserve the senior deduction. Finally, there is the Legacy Planner, focused on wealth transfer. Roth accounts have no required minimum distributions during your lifetime, which allows your assets to compound tax-free indefinitely. For your heirs, an inherited Roth IRA avoids the immediate tax burden of the 10-year distribution rule, making it one of the most efficient ways to transfer wealth. This approach requires paying maximum taxes today in exchange for absolute tax immunity for the next generation. Navigating 2026 requires more than a simple comparison of tax rates. You must calculate your magi, review your employer's plan document, and select the specific combination that addresses your most pressing financial bottleneck.